Hey everyone, I hope you're all doing well out there. This is your August market review. So the reason that I put these videos together each month is to give you the straightforward information with no media spin, political angle, or fear tactics that many media outlets use to get more viewers to watch their shows. My goal with this is to give my clients that information about what's going on in the market and the economy and then how that affects their money. So some housekeeping items here for my clients. If you noticed, and if you didn't notice, I'll let you know now. Your account has officially been migrated over to Charles Schwab from TD Ameritrade. Nothing on your end changes. It's something that's been in the works now for about 3 years. I've been talking about it over the last handful of months, and I know I've talked with a number of you about it over the years about this happening. Nothing changes for you as a client. The only difference might be is that if you went to the advisor client website through TD Ameritrade before and you like that view versus the client portal, you now will have to go to the Schwab Alliance website through Charles Schwab to access the account that way. I suggest that everybody use the client portal. It has all the same information and more graphics and charts and everything you need all in one place. So I would suggest using the client portal. If you've never logged into the client portal and you'd like to, just shoot me a text, email, call, something, and I can send over the intro logging credentials and all that kind of stuff to get you set up with that. So, but if you do have any questions about the Schwab merger and anything involving that, more than happy to answer any questions. Really nothing monumental. It's kind of just like a bank merging with another bank. It doesn't really affect the end client. It's just really better for the banks at the end of the day. So, which in this case is very similar. While there's not a lot of change on your end, there's a lot of change on my end. Hopefully eventually for the better. Right now there's just a lot of operational things that I'm adjusting to. So if I'm a little bit slower with getting back to stuff, that's just because I'm swamped with doing back end things right now, which isn't really the fun stuff, but part of the job. So some of the market info here that I'll go over. The month of August, the market was down, still up 17% year to date so far. This was as of September 14th. Apologize for getting this market review out a little bit later, but kind of like I said, over the last couple of weeks since Labor Day when the Schwab merger happened, I've been very busy. So did want to get this out to you though, because I think the market reviews are very valuable, and I know a lot of clients actually really appreciate that I put these out there. So didn't want to shortchange you and wanted to get this out there as soon as possible. On a short-term basis, stocks are slightly oversold as of September 14th. Some short-term indicators that I follow indicate that they're a little bit oversold. So if you have some money that you have sitting in cash right now in a bank account, or you've been thinking about adding money, now's a good time to do it. For a number of you that had cash sitting in accounts over the last handful of months, I got a lot of that to work in August. So that was something even for clients that are in the sector rotation strategy, which if you have an IRA with me, part of your portfolio, the stock portion is held within that strategy. So I brought the cash position, which was sitting actually in a short-term bond fund that made about 5%. I brought that cash position from 8% down to about 2-3% within that sector of the segment of the portfolio, just because markets did get very oversold in August, and it was a great opportunity for new money or cash that was kind of sitting in more conservative parts of the portfolio to get reinvested into the stock portions within the portfolio. So that's been a trade so far that's worked out well, and still, good timing for new money to come in, just because we are still a little bit short-term oversold. So a few charts that I have here. I wanted to go over the first chart that I'll pull up. It just shows the S&P 500 and the rate of return. This is as of very beginning part of September. It's showing the market up about 17% for the year. You can see that drop off though in August. That little blip down there where the market dropped down to about 13-14% up for the year. That was the timing when I ended up adding that money into cash or from cash to the market within that sector rotation strategy, and for clients that had money sitting in any cash within their portfolio that they had recently added. That's when I had been adding that. So that was something that I wanted to bring up to show all of you, just to give you kind of like, those are the things behind the scenes that I'm doing to help you guys make more money, basically, and take advantage of those little imbalances that periodically happen within the market. So that was just kind of a overview of performance for the markets for the year. One chart that I have two charts here that I thought were very interesting. The first chart here is a chart of the S&P 500 earnings per share estimate for the next 12 months. So this is a chart showing what the analysts expect the S&P 500 to earn over all the companies to earn over the next 12 months. So this is always a forward-looking thing. It's just analysts predicting that these companies on a whole are going to be making X amount, and then combined that adds up to where right now is about $240 in earnings per share in the S&P 500. So this is a good sign that if we look at where we're at right now compared to where we were in 2020, that it very much so dropped off a cliff because of COVID. It rebounded dramatically, and then last year we had a little bit of a pullback where analysts expected that companies weren't going to earn as much money over the next 12 months. In this most recent quarter that just came out, the number of companies that had surprised on the upside for earnings, basically they made more than what analysts expected, was 79% of companies in the S&P 500 over this last quarter. So that's a huge number of companies that did really, really well, or better than expected with their earnings. 64% of these companies out there had better than expected sales numbers, which that's the top line and most important number in a lot of cases, because if their sales numbers are growing at a better pace, then ultimately they're going to earn more money on the very bottom line. So not to get into accounting, but that was a really big thing. That was a big win for this past quarter's earnings, and also a really good sign that stocks are likely to keep moving higher over the next 6 to 12 months because companies are doing better than analysts are expecting. So that when that happens, that leads to an upside surprise, which then leads to markets and stocks moving higher. So that was a chart I came across I thought was really interesting because it goes right into, I'll have questions every now and then of, well, where do you think the markets are going over the next 6 to 12 months? And no one really has a crystal ball, but these analysts that are doing all this work trying to figure out, well, what company is going to earn what amount, and based on all these very specific things within that company, if these analysts are actually looking at these companies and the companies are then outpacing what the analysts are expecting, that's a really good sign that stocks are likely to move higher over the next 12 months. So something that I looked at and felt good about looking and seeing that. The other chart that I have here for you this month is it's the Personal Consumption Expenditure Price Index. Basically, this is inflation. So this is the rate of inflation over a 3, 6, and 12-month time frame. You can see the different color breakdown there. And then the black dotted line right at 2% is the Federal Reserve's target inflation rate. This chart goes all the way back through 2018. So the rate of inflation has dramatically come down from where it was at the beginning of 2020 or 2022 to where it is right now, where most of these numbers are anywhere from 2 to 3.5%. So this is a great sign, because the biggest issue that was holding stocks back last year and what led to the drop off in 2022 was the dramatic spike in inflation. So if we have inflation more under control, which is what it looks like right now, then companies are going to be making more money and passing that money through to the bottom line, which is the earnings per share, because they don't have to spend more to make whatever the product is, or pay more for employees because of wages having to go higher. This is a great thing for not just those individual companies, but then as a stockholder, an investor like all of you guys out there, this is a great thing for you, because that means that there's not something that's going to be holding the markets back with inflation as a big economic thing. So I thought that was a very timely chart, just because inflation over the last year and a half has been probably the biggest headline from an economic standpoint. So where we're at right now from an inflation standpoint is at a very normal spot. So while prices aren't going dramatically lower, the fact that they're not dramatically increasing at the rate of 8-9% like they were a little over a year ago, that's really what we want. So if you have any questions, don't hesitate to call, text, or email me. If you have friends, family members, somebody that you feel would be interested in having a conversation with me, be more than happy to have a conversation with them. Just give them my number to allow them to get in touch with me, or if they prefer me just reaching out, get me their contact info, and I'd be happy to reach out to them and have a conversation with them. I appreciate you all taking the time to check me out. Until next time.